You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today. I'm answering a question that I received last week from one of my members. He started to worry about Canadian Natural Resources, CNQ. This huge oil and gas behemoth, like a rock of a dividend grower, and yet the stock price dropped by 22% between its peak value in April all the way down to September when it was trading around $44. A few days later, so I received that question last week, a few days later today, before the market opens on October 2nd, the CNQ is still down 16.7% from its peak value in April. So what's going on? Should you do anything? Should you worry? Those are like common questions, especially when we see such a great company going down double digit rapidly. So first, you have to put some context in there. And you know me, I'm going to tell you not to panic. Like ironically, if you just look at the past 12 months, well, the stock price is up 6.8%, not counting the dividend. So if you even count the dividend, it's going to be even better. Your investment over the past 12 months is up like about 12%. So should you panic for a 20% drop? Well, if you put that into perspective already on 1 year, but if you look at 3, 5, and 10 years, you're going to realize that that's kind of like not the right question to ask, right? However, you probably wonder what's going on and why the stock price drop that fast. And this is where it is so important to understand a company business model. So what I told my member, I'm like, yeah, well, you can go back on the Dividend Stocks Rock stock card that explains in the potential risk. And sometimes it's a common mistake that we all make when we invest in a company. We get super confident. We get hyped around the stock. We are super bullish about the growth potential. And then we kind of forget about what could go wrong. And there was one line that was very clear in our potential risk analysis was, however, you must be ready to ride the roller coaster as CNQ stock price continues to be as volatile as the oil barrel. So that's the key point here. Any energy company will fluctuate according to commodity prices, unless it's pipelines, which is a totally different business model. But CNQ does not just own the pipelines; it's also produce and extract the oil. So that's why it's really important to understand what is the context here. So if you look at the Western Texas Intermediate, WTI, which is a pretty good oil pricing benchmark, between April 1st, 2024 and September 30th, 2024, the oil barrel price was down by 15.6%, while in those exact dates, CNQ stock price dropped by 14.27%. So if the oil barrel goes down, CNQ is going to go down. But then you're going to tell me, but Mike, that doesn't make any sense. CNQ is a super solid business. They own very high quality assets. They make money. They are profitable as long as the oil barrel is trading above $35, which we are pretty far away right now. So what's the problem? As long as the oil barrel trades around the 70s or the 80s, or even if it goes to $60, it's not going to be a problem for CNQ. They're still going to be able to manage their business, pay a dividend, increase it, pay down their debt, because they will be profitable. Well, here's the thing. The stock market will price CNQ based on its future earnings. And while the company will be profitable, it's going to be less profitable if the oil barrel goes down by $20, right? So it's only normal that it reflects on the stock price. Now, should you bother short-term stock price for a stock like this? I mean, not really. CNQ is a long-term play on the energy sector. So if this is why you are in, well, you are in for a company that will continue to be profitable, pay down debt, buy back shares, increase their dividend year after year. But do not make the mistake thinking that the past 3-4 years on the stock market will be what's going to happen on in the future for CNQ. So if you look at the bottom price, if you have picked it up like in the late 2020 or in 2021, you more than doubled your money with CNQ, which is amazing. However, if you look at the long-term trend, there was not much price movement between the moment where it was trading in 2014, 10 years ago at $20, and right before COVID, where in December of 2019, it was still trading around $21. So you have to also put that in context where the stock price has not moved that much for like a good decade. So between 2010 and 2020, the only thing that you were getting out of CNQ was the dividend. And it's likely going to be like that for most of the time that you have it in your portfolio, not for a few years. Like right now, the past few years have been amazing, but after that, what's going to likely happen is just a stabilization in price. So CNQ is a lot more like a very strong deluxe bond. So a company that from time to time, you're going to have a jump in the stock price, but most of the time it's going to be relatively stable, but you're going to have a very healthy dividend that will increase faster than inflation, and that will pay a solid yield. So those are the context around buying Canadian natural resources. So if you are in for that, just forget about the stock price. Do not look at it, especially for the short term. You know, we keep talking about the anchor bias where we see a stock price trading at a all-time high. So if it's like $60, well, now the stock price in our mind is $60 forever, unless it goes up. If it goes down, we're always going to say, well, that stock maybe trades at $14 now, but it is really valued at $60 because 2 years ago it was trading at $60. Well, that's just price anchoring. At one point, yes, it was trading at that level, but it doesn't mean it's going to come back. As on the opposite side, you could very well buy it at the all-time high and still make a good deal. I mean, if you bought Canadian natural resources at $30 in 2022, that was the all-time high, and it was still a very solid deal. So instead of like focusing on the short-term price and determine what you should be doing, just go back on the last quarters, the last few years, and look at the dividend triangle. Do you see anything weakening at CNQ? Yes, the revenue and the earnings are slowing down. And it's only normal because the oil barrels stopped going up. So starting around mid-2022, if you look at the revenue and the earnings, they are on a slowdown. So it's normal that the stock price will not skyrocket at this point. And it's also normal that the company will see a normalization in their revenue and earnings. And it's not true. They're going to continue to grow double digit all the time. It is a more stable business than a super fast growing company. So CNQ has nothing to do with a tech stock. It is a stable business that from time to time, yes, you're going to enjoy an amazing bull run, and then don't get scared if you see the stock price slowing down a little bit. So my investment thesis around CNQ has not changed and will not change based on short-term price fluctuation. I don't care if it goes up or if it goes down, mostly because I'm in for the long run, and then I look at the dividend triangle. I know that this company is cyclical. It's going to follow the oil barrel, so I don't put too much time looking at the stock price, especially when this summer it was really rough for the energy sector. So there will be another day where the oil price will going to come back. We can see that already the stock price went from like 44 to almost 47 in a few days. So again, you can appreciate the fluctuation. So once again, if you want to find interesting companies to build a watch list and you don't know where to start with the Rockstar list. You can download it for free at moosemarkets.com/rockstars. And the best of it is the list has just been updated this week. So this very Friday, if you subscribe to moosemarkets.com/rockstars, you're going to receive the latest update for the Rockstar list. So it's going to be nice. You're going to have like a long list, like a like a few hundred stocks trading on both Canadian and US market with great fundamentals. So it's a great place to start your research to buy your next amazing company. So all right, Moose, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.